following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM WNBU, cable TV 10 in New Bern, as well as streaming on the internet at dlblain.com. Today, I believe, is actually our 100th show that we've done. We started on 94.1 a couple years ago, and we have some special 100th show anniversary coming up. We got a lot of neat things for you, but didn't have quite time to put it together for this week. So make sure you tune in next week. We'll be doing sort of a little celebration for our 100th show. We've got some special topics that we're going to cover. We're going to look back over the past several years and pick some of the most salient and timeless advice that we've given over the years and kind of recap them. But don't be despaired, because today we've got a great show for you too. I thought it might be useful to start taking a look at the real estate market. We haven't talked about real estate in a while, so I'm going to devote the majority of the show today to real estate. Before we move on to the show, let's give out the phone number here, which is 252-633-0107. Our email is allthingsmoney@dlblain.com. And as always, we welcome our viewers and listeners' input to the show, both comments, questions, good, bad, topics you'd like to hear, topics you're tired of hearing of, whatever comments, we will take them all into account. You can also go to the internet, our website, www.dlblain.com, and there you'll find archived copies of the show as well as some other good information on myself and my company. Okay, I think that's all the administrative stuff for today. Let's get right into the show. Somewhere around 2003, 2004, the housing market was really in full swing. I mean, I remember we had a client that here at the beach, they bought a lot at the beach, and they bought it. They paid a tremendous amount of money. I was really nervous about it. You know, it was a lot. I thought it was too much. And they came back about 6 months later, and they said, "Hey, David, guess what? Remember that lot at the beach I bought?" I said, "Yeah." They said, "Well, guess what? I sold it for twice what I paid for it 6 months ago." And first of all, I said, "Well, congratulations. You know, that's great." And then I started thinking, this is the beginning of the end. If you know, when real estate is doubling in 6 months, this has got to be the beginning of the end. And sure enough, by pricing data, by number of units, new construction, all sorts of different measures that we see, they all started peaking out in 2004, 2005 timeframe, and it's been sort of an arduous number of years as we try to get back to some sort of normalcy in the housing market. And so that's what I want to do today, is just cover some of those things. We'll look at valuation of the market, we'll look at pricing, we'll look at rental statistics, we'll look at some foreclosure statistics, and all things sort of housing. The bottom line of this is I think we're getting close to getting back to what we would call a old normal, where things were, you know, pre-2004 for a good number of years. It's important to understand where we're in the cycle, because this is not going to happen overnight by any means. Let's start off by taking a look at what we call real pricing. Pricing, we got a couple of valuation metrics we'll look at. We'll look at pricing, activity, price to income ratio, financial obligations ratio, price to rent ratios. We'll look at financing. We'll look at price to replacement cost ratio. And then finally, we'll look at relative asset value. So there's a number of ways to look at the value of housing, and we'll take a look at all of them. So first of all, as we want to look at housing on an inflation-adjusted basis, and we see that the existing single-family home price has declined the past year by about 3.3%. On a real basis, it's declined about 5.8% year over year. And most of the data I'm going to talk about today is through the third quarter. We should be getting another round of data at the end of the fourth quarter, but a lot of what I'm talking about today is going to be from the third quarter. So we see that the median home price is currently $165,600, the median home price in America. And we look at the inflation adjusted, we see quite a decline in value from the peak that hit right at about the first quarter or so of 2005. We also look at the FHFA House Price Index, which is the Federal Housing Finance Authority. If we look at some of the data from them, we see we're about 8 to 9% away from what was sort of normal between almost 1970 and the late 90s. You had sort of this normal trend of housing, and it kind of went up and down, but you had sort of a normal trend. We see that we've got about another 8% to go before reaching that trend line that we saw. Now, one of the things that I'd like to point out, talking about real estate, as anybody that's familiar with real estate, a lot of it is very local oriented, and everything I'm talking about today, there are some regional and state-specific information, but I'm talking about in general the housing market of the U.S. and its aggregate statistics. Of course, your neighborhood or your town may be experiencing something different than what I'm talking about, but as far as an economic indicator, in the country, if you have a major city like Las Vegas just getting pummeled in real estate, it does have an effect all over the country. Okay, if we look at activity, actually back to the median home price adjusted for inflation is falling. We see that it's falling back to levels that we saw at the early 1990s. Another thing we look at is also activity. We see that the dollar amount of housing turnover is about 6%, which is a cyclical low, matching some of the decline we saw in the 70s, 80s, and 90s housing depression. So activity is slowed down to what we typically see at a low. We see price to income ratios where we look at the price of housing versus what people make. This is a very important statistic. We see that in 2005, housing was over 2 standard deviations above the median family income average. And that's just very unsustainable. That is, in fact, the definition of a bubble. We see that the median family income about 61.5, so that ratio has dropped down to 2.7. During the bubble, it was above 3. Well, we come to our first break, and we come back, we'll continue talking about the state of the housing market in the United States. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.